In 2023, the World Bank projects that the world economy may experience a recession and one of the slowest rates of growth ever. The World Bank slashed its forecast for global growth in 2023 by almost half, from 3% to 1.7%. This represents the third weakest growth rate it has ever anticipated, below the rate seen during the recession of 2009 and 2020. Why do chief economists believe that the global recession is likely to occur in 2023? The majority of the community of chief economists at the World Economic Forum predict that there will be a worldwide recession in 2023, that geopolitical tensions will continue to influence the global economy, and that there will be more monetary tightening in both the U.S. and Europe. The chief economist outlook was unveiled at the World Economic Forum annual meeting in Switzerland, and these are its main conclusions. Nearly two-thirds of chief economists think that there is going to be a worldwide recession in 2023. Of them, 18% think it's quite likely, which is more than twice as many as of September 2022 poll. A third of those surveyed said that they didn't think that there would be a global recession this year. All agree, however, that 2023 will not be a good year for growth, particularly in the U.S. and Europe. While 91% of senior economists polled predicted weak or very weak growth in the U.S. in 2023. All chief economists surveyed predict weak or very weak growth in Europe. This indicates a decline in recent months. The corresponding numbers were 86% for Europe and 64% for the U.S. at the time of the most recent study. Growth expectations are highly polarized in China, with respondents nearly evenly divided between those who anticipate poor and strong growth. Growth is predicted to increase as a result of recent efforts to lift the nation's extremely restrictive zero-COVID policy. However, it's unclear how disruptive this change will be. The leading economists observed considerable regional differences in inflation, with the percentage of respondents anticipating high inflation in 2023 ranging from just 5% in China to 57% in Europe. The leading economists stated that they anticipate the monetary policy stance to remain unchanged in the majority of the world this year, following a year of severe and coordinated central bank tightening. Most people do, however, anticipate more tightening in the U.S. and Europe, 59% and 55% respectively. They pointed out that the politicians would probably have to strike a tough balance in 2023 between tightening too much and too little. The international economy is in peril because two-thirds of the senior economists predict a global recession in 2023. According to World Economic Forum Managing Director, the current high levels of inflation, low growth, high debt, and high fragmentation reduce incentives for the investment needed to get back the growth and raise living standards for the world's most vulnerable. Leaders need to see beyond the problem of the present and make investments in the innovation of food and energy, in education and skill building, and in high-potential future markets that will create jobs. This is the essence. In 2023, a number of obstacles are predicted to hinder business activity. More than 60% of respondents also mentioned increased input costs. Of the respondents, 90% predicted that businesses would be burdened by both low demand and high financing costs. Multinational corporations are anticipated to reduce costs as a result of these difficulties. According to several chief economists, they will cut operational costs 86%, fire employees 78%, and improve supply chains 77%. In a broader sense, the chief economists anticipate that firms will continue to face challenges in the global landscape. All of the respondents anticipate that geopolitical trends will continue to redraw the map of global economic activity along new fault lines and fissures. This broader economic change will probably have an impact on labor, trade, investment, and technological flows, posing a variety of opportunities and difficulties for companies. The fact that supply chain interruptions are not anticipated to significantly hinder economic activity in 2023 is one encouraging sign. The cost of living problem has been identified by the Forum's Global Danger Report 2023 as one of the most pressing global dangers. Nevertheless, the chief economists believe the crisis may be approaching its apex, with the majority, 68%, anticipating it to have lessened by the end of 2023. Regarding the energy issue, a similar pattern is seen, with 64% of respondents anticipating some improvement by the year's end. Furthermore, the survey participants indicated several possible reasons for hope in the beginning of 2023, such as the stability of household finances, increasing indications of decreasing inflationary pressures, and sustained robustness of the labor market. What are some of the reasons that led to such a situation? The unanticipated increase in inflation is the root cause of the turmoil. The Federal Reserve raised the federal funds rate by 4.25 percentage points to a level last seen in early December 2007. The Bank of England raised rates by 3.25 percentage points to a level that exceeded in November 2008, and the European Central Bank raised rates by 2.5 percentage points to a level last seen in December, with the Bank of Japan being the notable exception. Bond yields have increased as well. The yields on 10-year gilts, German bonds, and U.S. Treasuries have all increased since the end of December 2021 by more than 2.6 percentage points, 2.2 percentage points, and 2.3 percentage points. This year ended with stock markets that were noticeably volatile, but far from being cheap. By the end of 2021, Bitcoin had dropped from $65,000 to around $16,600. In the United States, the Federal Reserve slashed interest rates to 0.25% in 2008 and left them there for 7 years, and gradually raised them to 2.5% in 2018. They progressively decreased to nearly zero in the midst of the epidemic. The rate in the UK was reduced from 1% to 0.5% in 2009, and it didn't go back to its previous level for the following 13 years. It won't happen if it doesn't. This uncertainty about the outlook for monetary policy must endure as long as it does. As debt becomes more expensive, higher interest rates will cause casualties. The market instability is also expected to persist given the uncertainty. The combination is probably going to raise defaults and shake off overbought assets. Defaults will become more probable if rates continue to rise, not just in emerging and developing economies, where there is obvious turmoil. High-income nations will also put pressure on highly leveraged ventures. Recessions, according to Austrian economist Joseph Schumpeter, result in creative destruction. At the very least, expensive cash will serve as a necessary reminder that using leverage is never a one-way bet. The longer-term question is whether the free money period is passing through a blip or coming to an end permanently. In The Great Demographic Reversal, Charles Goodhart and Manoj Pradhan, among others, make the case that demographic dynamics would eventually lead to increased inflation and interest rates. Oliver Blanchard, a former IMF senior economist, contends that once the current inflationary shock is past, the dynamics that have led to low real estate rates on safe assets will still be in control. How has the free money in the market caused trouble? The tech sector has been characterized for more than 10 years by two economic zeros. Due to the zero interest rate policy, ZIRP, implemented throughout the Western world, the cost of money fell precipitously, allowing startups to operate at a loss for several years and piquing investors' interest in taking enormous risks that could result in significant rewards. The growth of AI technologies poses a danger to the production model that has enabled the sector to achieve its current dominance, while governments around the world have increased interest rates in the last-ditch effort to contain post-pandemic inflation, and as a result, the coming decade may be substantially different from the previous one. The degree to which the future differs from the pre-inflationary past will thus depend on how quickly inflation declines and how high real interest rates rise. However, the cost of both money and risk has increased recently. That presents danger and chance. Interest rates didn't exactly reach zero in most of the Western world, but they were lowered to such low levels that they didn't matter when inflation and GDP stagnated following the Great Recession. Do you think the world economy is about to collapse? Let us know your thoughts on this. For more interesting stories, subscribe to the channel, and don't forget to press the bell icon for notifications. Goodbye.